Saturday, August 22, 2026, and the crypto market has just delivered one of its most brutal short squeezes in months. More than $4 billion in bearish positions were wiped out this week, with over $1 billion of that in a single hour on the 19th. Ether was the standout, jumping almost 19% in 24 hours at one point, while Bitcoin climbed around 8.8% on the week. This is not normal momentum. When traders sell borrowed coins expecting a fall, a sudden price rise forces them to buy back, and that forced buying feeds the rally even faster. That is exactly what happened. The spark was not simply technical. On August 19th, Bitcoin pushed to roughly $69,500, its highest level since early June, after the White House met crypto executives and the US Treasury expanded bond buybacks. That matters because bigger buybacks inject liquidity and reduce longer-term yields, making risk assets like crypto more attractive. At the same time, demand through exchange-traded funds created steady buying rather than speculative froth. Bitfinex analysts noted that squeeze-led rallies normally fade, but ETF demand, the macro shift, and a lack of heavy selling give this one a longer runway. Bitcoin's gain was strong, but Ether stole the week, up roughly 18% over 7 days compared with Bitcoin's 8.8%. Over 24 hours around August 20th, Ether surged nearly 19%. That forced a wave of short covering because traders had been betting against Ether more heavily. It also signals a rotation inside crypto, with capital moving beyond the largest coin. When the total market capitalization rose 3.7% in a day, this was not just a Bitcoin story. The wider market was repricing risk. Beyond the price action, Elon Musk's X is reportedly exploring USDC, Circle's stablecoin, to pay creators under its new original content rewards program. This would replace the older revenue-sharing system, although no final decision has been confirmed. The significance is bigger than one platform. Stablecoins already have a combined valuation above $300 billion. If X starts using USDC for real payouts, it turns stablecoins from trading tools into everyday payment rails, and pushes digital dollar payments directly into creators' pockets. That is adoption with a concrete user base. The near-term question is whether the gains hold. Squeeze rallies can reverse quickly once forced buying exhausts itself. But the combination of ETF inflows, Treasury liquidity support, and improving regulatory progress in Washington gives the rally a more durable base. Watch for small retracements rather than a sudden collapse, and keep an eye on ETF flows and any official confirmation from X. If more platforms adopt stablecoin payouts, the next leg may be driven by utility, not just short covering. For traders, the lesson is that positioning can turn into fuel. Almost $2.7 billion of bearish positions were closed in 24 hours on August 20th, the largest wave since 2021. When sentiment flips from fear to greed this fast, chasing the move becomes dangerous. For the wider market, the combination of macro liquidity, institutional demand, and stablecoin adoption points to a maturing asset class. The bears provided the kindling. The real story is who is now holding the assets.